Candle Range Theory Trader back with another video on how to trade candle 3 and 4 on the daily chart. So remember that when we use the daily candle range theory, you have to understand the structure of the market, okay? And you have to assign each candle a label as far as what you believe it is. It doesn't mean you're right, but you can operate from this framework. So candle 2 on the daily chart always is going to create the high or low of the week. Candle 3 is always going to continue the momentum from candle 2, although it can be delayed by a day, okay? Inside days can be a clue for that, and I'll show you in a second an example of that. And then candle 4 continues the momentum from candle 3. That also can delay it by a day. So the mentality you have to approach the chart is this. You have to use this mindset. I'm only going to trade candle 3 or candle 4 daily candles. I'm going to monitor the price around key levels to look for entries. I don't enter at random. Okay. My bias is valid as long as the low or high of candle 2 holds. If the low or high of candle 2 is broken, the structure is broken, and I'll just look for another trading opportunity somewhere else. Okay. Candle 2 is the key to this whole deal. So, what are the key price levels? It's going to be 50% of candle 1 when you're trading candle 3. And when you're trading candle 4, you have a couple. You have 50% of candle 2 or 50% of candle 3. And again, I'll show you this so you'll see it for yourself. So it's all going to depend on how you frame the range. But you can use a fib tool with just a 50% line. I don't talk about 618 and 712 or whatever else. No, you don't need that. Okay, so here's the first example of a long. This is a daily chart, okay, 5 days. Now let's walk through this. The low of the week, I'm just going to start from candle 2. The low of the week is this candle right here. This is candle 2. This is a Tuesday. Now, this is what I was talking about when candle 3 can be delayed by a day. Because candle 3, what you would think would be candle 3 would be the very next day, didn't give much price action. This is Wednesday, this small red doji, right? And some people will read this as a possible reversal. However, we're trading off this candle 2. So because candle 2's low is still intact, we're still long. And candle 3 activity came on the following day, which was Thursday. Thursday, remember our key level, the middle of candle 1. So you do draw that fib from the top of candle 1 to the bottom, and you're comfortable to trade around or below this green line, at least on my chart. This is below the 50%. So you want to try to look for your longs in there based on the range of candle 1. So it's candle 1, candle 2, and you're just looking for that expansion, which came right here on Thursday. And then Friday gave a small candle 4. Some candle 4s are great. Some of them not so much. Okay. But you did get some more, a little bit of a continuation on candle 4 Friday. Okay. So that's one example. So your trading days, you could have looked for a long here. You might have get some price action, but the better ones are here and here. So you actually had 3 opportunities. This one, and this one. Right. Okay. Next. So we have another long CRT. The low being Monday. So this is actually the prior Friday. This was Friday's range. Monday created the low of the week. Now this was a clean candle 3. This is your trading day. Price wasn't quite near the middle of candle 1. However, once you see this candle start to form fair value gaps on a lower time frame and start to possibly break out, go ahead and hop in and get in wherever you can. Because typically candle 3s look like this. They immediately get out of the range when candle 2 closes. Okay, it may retrace some, but sometimes it'll just explode up. Candle 4 was Wednesday, but there were no pullbacks. This was a straight rise. It's tradable, but it might be harder to enter because sometimes you don't know if candle 4 is going to retrace. You don't know if it's going to do a straight rise, especially if it's outside of candle 1's range. So sometimes candle 4 can be the wild west. I prefer the retrace, but I wanted to include this opportunity or this candle because you know that this is a possibility. So maybe you can get in around the 3rd or 4th fair value gap here and just expect this straight breakout. Okay, it's just capitalizing on the momentum of candle 3. Again, I do not trade candle 4. Candle 5. If there's another 2 candles after that, that's fine, but I'm only focused on candle 3, candle 4. After candle 4, I'm done. Okay, that's how I trade. If you want to do something different, that's on you. Here's another long one. Okay, so we have the low of the week on candle 2. 1, 2. Okay, this is candle 2. Now, this is an imperfect candle 2. What do I mean when I say that? To me, an imperfect candle 2 means that sometimes candle 2 does not always close exactly inside candle 1's range, but it may close slightly outside of it. It could be about 10, sometimes 15 pips, depending on the ATR, or below. If it closes like 50 pips or 20 pips and above outside of candle 1's range, no, not so much. Okay, but The better trade on this one, if you weren't sure, I'd say candle 4 would have been the best trade for this. If you weren't sure this was a candle 3, you're definitely confirmed that the reversal is underway when candle 4 comes. It's still in the middle. Remember our key price level. The middle is the key price level of range candle, candle 1. Candle 4 did open around there. You will find a trade that, and that's fine. So your trading days here were Wednesday, definitely Thursday, right? But one of these two. And obviously, once again, you're seeing why I don't trade after candle 4, because this next day didn't give much of anything. It didn't really move at all. Okay, so let's go to some short examples now. So we have the high of the week being Wednesday right here. This is candle 2. And it perfect. I mean, this is this textbook. It closed right at the middle of candle 1's range. Straight drop. Boom. Now, Friday's a little different, okay, because Friday was a retrace example for candle 4. Okay, it opened, it retraced, then dropped, and then closed, okay? So what I'm going to do now is show you how we frame candle 3's range to help us take candle 4. Because candle 1's range didn't come into play for candle 4, all right? It was candle 3, so let's take a look at that, okay? So, but this was here. This was your trade for Thursday. So let's take a look now at Friday. So we just shift the framing. We're going to draw a fib from the top of candle 3 to the bottom of candle 3, and we want to trade above the middle of candle 3 in hopes that price will drop. Okay, that's what we're looking for. So that price action and this framing gives us a guide to let us know, okay, I'm not trying to go short all the way down here. If price opens and it opens green, then you want to wait to see, okay, well, how far is this thing going to pull back before it actually going ahead and tanks, like I believe it will. So in this case, it also hit the weekly open, but I'm not talking about that. Just above the middle is fine. So you start looking for some fair value gap, red fair value gaps off of the high of the day for candle 4, and your anticipation once again is that price will drop. So this is another one. So you have candle 1 and then candle 2 right here, which was Monday. Okay, this was Friday, Monday here. Candle 3 was right here. Now, candle 3 gave a little bit of a retrace. It was around the middle of candle 1. So anywhere in there is fine, or even around the open of the candle is fine. You ride that momentum down, get out when you can. And then candle 4 just continued. It retraced a little bit and then came back up. Okay. But now, as you see here, you're seeing why, again, I don't trade after candle 4, because look how price came back on Thursday and Friday. Thursday and Friday are these two green candles right here. After candle 4, I mean, that's it. I'm on to another pair. I'm only looking for candle 3s, candle 4s. Okay. No matter what time frame, 8 hour, 4 hour, it doesn't really matter. Okay. But after candle 4, no. Okay. Now here's another one. Here's candle 2 right here. That makes the high of the week. This is on Wednesday. So then you just got Thursday and Friday giving you the rest of the price action to the downside. This was another imperfect one. As you see, candle 2 closed a little bit above candle 1. Okay. But again, candle 3 was a straight drop, and then candle 4, another drop. So easy enough, right? Right. So let's see. I wanted to throw this slide in here as well, because remember, as great as this pattern is, nothing is guaranteed. So this is an example where you did have a high of the week. It closed inside of candle, what you believe could be candle 1. This red candle being candle 2. But look at candle quote unquote 3 and 4. They didn't go. They didn't drop. Right. So even though this high held, the market just consolidated. Didn't do much of anything. So when you know what candle 3 and candle 4 behavior looks like, and really candle 3 and candle 4 should behave generally the same, then you know that, okay, hold on, like it's like 2 in the afternoon and the candle's still green. It's supposed to be red. You might not be dealing with continuation. You might just be dealing with consolidation. Okay. So you could just take a small profit, a break even, or even a small loss. But, once again, if price isn't doing exactly what you expected in a timely manner, just cut the trade. Look for another one. Okay. Or wait for the next best setup. They all won't do this. So in conclusion, it's all going to start with where the high, the low, or the weak is. Okay. Everything is framed off of that. Be sure to frame candle 1 with a fib, and then try to take those candle 3 entries below it, below the middle of candle 1 if you're long, or above the middle of candle 1 if you're short. Candle 4 can sometimes be harder to trade, because sometimes it can just move in a straight line. When I say that, I'm talking about this one right here. Okay, this candle 4 is possible. It just, just goes. There is no pullback. So you just try to get in wherever you can and always use a stop loss. So never trade candle 2. The big money is in candles 3 and 4. Okay, why would you trade a doji candle. This is not worth it. Okay, here's your big money if you're short, and here's your big money if you're short. This is just your confirmation. Candle 2 is just your confirmation to let you know, hey, look, price could be ready to start reversing. Now you can start to make money on the opposite side. Okay, but don't trade candle 2. It's just not worth it. Remember, if you miss candle 3, the beauty of the CRT, candle range theory, just look for candle 4. If you miss candle 4, then you're back to looking for another pair. Try to find another candle 3. Okay, so I alternate between 3s and 4s. And the good news is, no matter your time frame, you can still use this basic price action on the 4-hour or the 8-hour. Okay, either way. But I just did a daily in this example. So I appreciate you watching. Thanks for your time and attention, and have a great rest of your day. Take care.